Urgent warning to investors. Today is October 19th, 2022. U.S. Treasury bond market collapse is underway. What comes next is a massive quantitative easing program. If rates don't fall, U.S. government is insolvent. It is just that simple. Pension funds are collapsing globally. Front run Janet Yellen launching Operation Twist. Normally the Federal Reserve does this, but the US government is desperate. You want to buy these 6 stocks right now. High risk portfolios up 21.39% total return year to date. Last year, our total return came in at an astounding 233%. The high risk portfolio in October is up 2.5%. And our safe growth strategy is killing it with a massive bet on oil companies with an 18% return to start out October 2022. Let's take a look at our high risk portfolio per unit of investment. Now, if you're a paid member, you can log in and punch in how much money you want to invest, and it'll automatically calculate exactly how many shares to purchase. All of our members follow 1 unit of investment. And currently a unit of investment is $2,102. So 1 unit is currently 19 shares of UVXY, 36 shares of TMF, 14 shares of EUO, 57 shares of ETHE, 27 shares of FNGU, and 1 share of NRGU. If you wanted to do 2 shares, double it down. If you want to do 10 shares, increase by 10. What's critical is to keep the exact ratio of shares in place. We're going to be walking through each position one by one throughout this presentation and put it all together, how this acts as an extremely strong investment vehicle that protects you against all the risks in the market. So let's break it down. On the pink lines, we have our defensive plays. We have UVXY, the stock crash insurance. We have the deflation play with a leveraged bet on treasuries, TMF, that's 3 times the 20-year, which just hit a high last seen in 2008, just remarkable. And then we're betting on the dollar against the euro, expecting the ECB or Europe to capitulate first and bail out their pension funds, further weakening the euro against the dollar as the war in Europe is wreaking havoc and spiraling their economies into a depression. Now, on the offensive side, we're anticipating that once again, central banks will have to protect credit markets, buy their own debt, deflate their currencies, and send offensive assets back through the roof. And so we're betting on Ethereum with the Grayscale Trust, ETHE. We're betting on the tech sector, a 3-time leveraged play. It's got 2 out of China that have been just absolutely obliterated, down something like 80% today from a high last year. And then 10 of the biggest US tech companies. Again, it's leverage times 3. And then we're betting that 10 gigantic large oil companies who have a monopoly in the market are going to benefit from the war in Europe. And that's a leverage product times 3 with NRGU. In fact, probably a trade alert coming soon will be to take profits on NRGU, which is going up a lot after Mr. I can't say his name, will get banned, but he did a speech today and it's making NRGU go through the roof. So we'll probably be taking profits on that within 4 to 8 weeks and rotating into natural gas with ticker BOIL. You don't want to miss that trade alert. Okay, so let's jump into the meat of the presentation. The 60/40 portfolio is the worst performance in 100 years on an annual return basis. Okay, so this is just horrifying, absolutely horrifying what has hit the markets this year. You have to go back to the Great Depression to get worse returns on a 60/40 portfolio. And really the only period that is worse is the Great Depression because it lasted several years and the US stock market went down 92%. So the problem is the US government has ballooned its debt to GDP to 150%, one of the worst in the world. And we cannot take these high interest rates. Now, the Federal Reserve is hell-bent on tightening policy And it looks like they're starting to break past with the Treasury. So the Treasury is now planning to do what's called Operation Twist, or at least that's what it was referred to in late 2011, 2012. So the last time we had interest rates at this level previously, the closest time was 2011, and interest rates were a big problem for the government then with far less debt, something like a third of the total debt. So what they did was Operation Twist via the Federal Reserve, and it managed to get interest rates to fall. And we're going to talk about why that's extremely bullish for cryptocurrencies. But now the Treasury is going to do it. So she wants to start issuing several $1 trillion worth of T-bills to get the 2 trillion out of the reverse repo, which is just a huge scheme to pay banks $300 million a day in interest, and then flood this into the US government's balance sheets and into the economy. And this could potentially fix the problem in interest rates and drive the dollar down and end this this chaos that's happening in markets. And we're getting it from all the big wigs. So we had Market Watch come out. We've got this Bloomberg article, momentum builds for creating a treasury bond buyback program. As we can see, the liquidity is at a very, very bad level, last seen in the lockdowns of 2020. Now, some people are saying this makes no sense. The Fed is doing quantitative tightening and the Treasury quantitative easing. This is like hitting the brakes and gas at the same time. It's completely crazy, but we're seeing governments all over and central banks all over the world do something similar, raise rates while print money. So we'll see how this all plays out. But I believe the Fed will have to follow the Treasury, and we'll look at a lot of reasons why. Now, this is some other indications that would give us the ammunition we need for the Federal Reserve to stop being so hawkish. Okay, so we need to see that the inflation is going to stop rising and fall rapidly to believe the Fed can really pivot with or without Mrs. Janet Yellen. So we've already got the credit market screaming that this needs to end soon, but let's look at the data. So this is PMIs relative to Treasury yields. And so you can see they have gone in opposite directions, extremely unlikely to continue. So either the PMI is going to skyrocket up, zero chance of that, or yields are getting ready to crash. And these yields could crash with the stock market going up, or they could crash with the stock market going down. And that's why treasuries can be such an attractive investment. Now, the biggest piece of the inflation that's currently problematic is the shelter in place and the wages. So this is looking at Zillow rent index compared to how the CPI is measuring the rent. And you can see the rate of change of the rent is crashing into negative territory. And we're seeing housing prices stall and fall. And we're also seeing applications go negative at a level we last saw, again, in the 2020 lockdown period. So I'm highly confident within 6 months, the CPI will be picking up a dramatically lower rent and shelter inflation print. This is looking at the food, another index. You can see the CPI, again, is looking at data very old relative to current pricing. The UN food price index is now crashing as well. So I'm quite confident that's about to fall. This is looking at rent prices with Zillow and apartment listings. You can see these have all peaked out in about December of 2021, have been falling all year. So once again, the Fed is looking at old data. This is looking at the wage growth tracker relative to job openings. We can see job openings have crashed at a very fast pace, and now we're going to see those wages catch down as well. And this, we're comparing a similar to the PMI. This time we're looking at ISM manufacturing prices paid in the black. You can see it's crashing lower, and the inflation is way up there, very, very far apart. So not only does it look like inflation is about to top out, it's looking like it's about to crash lower. Health insurance, another one going extremely negative. Container ships going from 15,000 to 2,500 from Shanghai to Los Angeles. So there's some remarkable moves going on here. Now, this is looking at the 70s relative to CPI and the stock market. I want you to notice, where did the bottom hit in the late 1974, early 75 period? It hit when the CPI peaked, not when it fell. So we might be at the very perfect time to get super aggressive on stocks in the coming weeks. This is just a look at how bad it is. Emerging market currencies are below the March 2020 lows when we had a dollar spike. Emerging bonds below, corporate bonds below, treasuries below, consumer sentiment below. I mean, we were locking down the whole world to get prices to this level. And now this is all being driven by forward guidance from a Federal Reserve. And that is really it. Real wages below. The ARK ETF, something like 72% down from its high. Chinese Hong Kong stock market is just absolutely crippled. British pound has crashed, and the euro trading at 98 cents on the dollar, probably heading to 90 cents on the dollar. And so what caused the pain? It's the rate of change of the federal funds interest rate. And it is off the charts. They increased it by 2,500%. Now, a lot of people believe you need to drive the interest rate above the inflation rate to get it down. I disagree with the level of debt. I believe they have done the job and they need to quickly reverse path. Otherwise, we're going to have a global depression on our hands. But meanwhile, the consumer is still strong. Bank of America and earnings have been really good. But Bank of America's conference call said those folks who had $2,000 in their bank accounts before the pandemic, they're still sitting on balances that are 5 times higher. Folks who had 2 to 10,000 before the pandemic are sitting on balances that are 3 times higher. Lots of cash out there. This is a history of the federal funds rate since 1979. And in general, the trend is to go to zero. And I believe in this decade, we will see interest rates pushed below zero in order to continue the global debt bubble. Otherwise, government's going to have to spend less than they make and reduce the debt to GDP, which would be horrifying to economies that are completely fueled by the money printing of their government. So that's the big picture in monetary policy. Meanwhile, the war is about to ramp up. All of Russia's allies are evacuating everyone in Ukraine. China is cutting off LNG to Europe. And it looks like things are about to get very nasty on that front. So the oil play and the natural gas play looks like we could make a lot of money in the very short term with that, while in a 2-year outlook, we're really bullish in cryptocurrencies, which we're going to jump into why those two fit together so well in a moment. Meanwhile, the market is at extreme hedging. The opportunity for a short squeeze is phenomenal. And what it's going to take is either the ECB going into QE, Janet Yellen doing Operation Twist, or just forward guidance of slower rate hikes and slower quantitative tightening from the Fed. And their next meeting is November 2nd. Another thing that is on a disaster path is the US has now banned chips to China. So their tech sector is under extreme pressure, and they're going to have to try to take over Taiwan, which has the most important chip manufacturing company in the world. So that is now in full throttle out of China. We'll see how that plays out. China would be more likely to make a move when inflation's very low, because they need lots of food and energy imports to survive. China's made a decision, says Bloomberg, to seize, or this is Anthony Blinken, to seize Taiwan on a much faster timeline. Pentagon wants to send $10 billion in preparation to Taiwan. So those are the top highlights. We're now going to break down each asset one by one. If you're not a paid member, you're going to miss the trade alerts, when to sell NRGU, rotate to BOIL, and a number of other trades like getting out of the dollar versus euro bet and go big on Ethereum. So call Dean now to upgrade at 505-322-7515. Okay, so we're looking at the strategy on a 1-unit basis. If you're going to just buy 1 unit, you'd be picking up 57 shares of ETHE, the ultimate growth asset. If you think yields are going down and the consumer is not going to fall off a cliff, which is what I believe at this point, as long as everybody starts to pivot within the next 3 months, then we potentially have a very good setup for cryptocurrencies to explode higher. And so let's look at the data, and the last 3 times in history where the US interest rates rose this much, and what happened when they came back down to cryptocurrencies. So Ethereum now down 58% year to date, up 9 95,000% from its beginning. And our play that you can get in your stock brokerage account is ETHE, the Grayscale Trust. Now it's down 68%, 69% compared to the real asset only being down 58. But it's your best bet if you want to stick in a stock brokerage account. Paid members to Portfolio Builder can actually outsource this position to a private equity company we have called Rebel Dividends, where we'll give you the real asset with leverage plus some of the altcoins that can greatly outperform. But if we look at the all-time on the Grayscale Trust, peaked out just over 40, currently trading at 830. And I highly believe this will probably peak out somewhere around 80 to 120 in about 2 to 3 years based on bond market cycles. So let's break it down why we're so bullish on cryptocurrencies at these price levels with a 2 to 3 year time horizon. So Willy Woo says Bitcoin took 6 months to get 1,000 users, 5 years to find 1 million users. Today, 13.8 years from inception, it has 300 million plus users, 4% of the world. At current growth rates, 1 billion users will be hit in the next 3 years. That's 12% of the world. There's these adoption rates, the world population. You can see the curve for the internet. We can see that Bitcoin's very, very early. We're very early in this. Okay, so we're going to look at some periods in history where interest rates rose too much and there was interventions to get them down. So breaking, the US bond market's crashing to extremely dangerous levels this morning that will soon force the Treasury and Federal Reserve to protect credit markets. The current interest rates could spark immediate action this month and influence the November 2nd policy decision. Now this just broke to a new low today. This was trading at 99 today. We've seen it at 97. So we're something like 46% down rather than 43. With the TLT now down over 43% from its 2020 high, pension funds are now blowing up, and one by one, central banks and governments are being forced to intervene. And so it looks like most likely Janet Yellen will move first, then perhaps the ECB, and then the Fed. It appears the U.S. Treasury will soon step in to stop the credit collapse with a selling strategy to sell short-term debt and then buy back and reduce the total outstanding long-term debt in a move to push interest rates lower on the longer end of the bond market and protect credit markets. A very similar action was done by the Federal Reserve, not the Treasury, in late 2011 and 2012 called Operation Twist. And it only led to an 11% gain in the TLT, which measures the interest rates on long-term US Treasuries. But the return in Bitcoin was phenomenal, a 2,993% return. So here's the chart over that period. TLT goes up 11% and Bitcoin goes hyperbolic to the upside. The most recent 11% gain in the TLT was back from March of 2021 through December of 2022. This also led to extreme returns in cryptocurrencies. So here's that 11% return just last year, not too long ago. And what happened next was mind-boggling. The crypto melt up actually front ran the move. So before the bond market recovered, it was still selling off. Cryptocurrencies saw what was going to happen before it occurred and had some phenomenal returns. Now, we're going to look at Ethereum's 339% return on this period. But if you actually invest in the applications being designed on the Ethereum operating system, you can make a lot more money. And the best analogy I have is Ethereum is like Windows, and all the other applications are these altcoins that we're investing in. One of which, called Sand, went up 18,000%. Curve went up 620%. Mana went up 369%. Polygon went up 334, Uniswap 264, Aave 154, and Link 80. So here's the chart, all of these assets at the same period of time where we had a lower interest rate regime. And again, with our Rebel Dividends private equity product, only available to paid members, you're going to get exposure to all of these with leverage. So rather than having that deadbeat ETHE position, you can greatly outperform by calling Dean now at 505-322-7515. We believe the Federal Reserve will soon also be forced to pivot by slowing down rate hikes and quantitative tightening, to prevent excessive selling of US Treasuries and stocks, which is being fueled by the Fed's fight against inflation with tightening monetary policy. And so there's some key predictions that are going to allow the Fed to pivot here very, very soon. Bank of America is calling for job growth to slow to a halt by the end of the year and then flip negative. Then the economy is going to start losing jobs rapidly as we approach next year. If this prediction's right, this will be very critical for the Fed pivot. Okay, so now another period where we faced rising interest rates and a strong dollar was when the Chinese economy, specifically their real estate market, was collapsing in 2015 and 16, which it is again right now. This again led to the dollar index going high, 103 this time. Now today we've seen it hit 114. So the move we're looking at occurring here is at least 2 to 3 times greater than the last previous episodes, at least in terms of total dollars flowing into cryptocurrencies. But let's look at what happened. They contained the problem via money printing and stimulating the Chinese economy. And the dollar index ended up falling from 103 to 92, a 10% decline. And here's the chart. 2017, it had risen to 103. And then just 8 months later, you're sitting at 92.5. And as this occurred, Bitcoin skyrocketed 464%, sending the price from $800 to 4,337 in 8 months' time. Now, we all know it didn't stop at 4,000. So let's look at some of these bigger moves. So here again is that period where we got that move. Today, we have all of Asia and Europe selling US Treasuries and stocks to get their hands on dollars for the sole purpose of using it to buy their own currency. The hope is to prevent a further collapse in their currencies against the dollar, which is happening globally. And the irony is this is accelerating the problem, and it has driven the DXY even higher than the last few examples to 114. There's that incredible move that really went skyrocketing in the last 4 months. So we're expecting interventions to be necessary by the US to reverse this trend in order to protect its stock and bond market from further collapse than they already have. Now, back in 2016, the US bond market, which we'll measure with the TLT ETF, had cratered from 145 to 120, a 17% move. Now, again, we're looking at a move that's 2 times that, 200% worse this time. And the DXY index hit 103. Once the problem had been contained, the bond market stopped crashing, the DXY index fell, and what resulted was an epic rally in cryptocurrencies. Now, I want you to note, with this chart, you can see the TLT was still crashing all the way up to the start of 2017 before bonds barely started to recover. Bitcoin front ran this just like it's doing today. Why do you think Bitcoin's holding strong at 19,000 while the bond market keeps tanking? Believes we're near the end. But here's what happened. In this chart, as you can see, Bitcoin was not crashing at the tail end of the bond market crash. It held steady, had some small gains, and then it took off to the horse races. And by the end of the year, it skyrocketed to over 19,000. Today, we sit on the longest and deepest crash in the US bond market history, resulting in over a 44% decline in the TLT. And this has driven the dollar to a very high level, 114. Just mind-boggling. But the reversal of this is what we want to get ready for and excited about. So buckle up, expect volatility in cryptocurrencies and stocks until the credit market collapse is contained and bond values are once again rising. This can't be allowed to go on for much longer. We're very soon to pivots from these major power horses. Now, this chart is focused on what's happened to the price of Bitcoin. But I want you to know this perfectly aligns with the credit market cycles of interest rates. And this is predicting we could see Bitcoin hit 200,000 by early 2025. And this will be correlated to the dollar index falling and interest rates falling, or in other words, the TLT going higher. And so the only way around this is if governments decide to stop spending money they don't have. Governments now must choose between reducing spending. Nobody's doing this. No one's even talking about it. Or manipulating the bond market interest rates lower to protect the value of debt. And again, the only way they do that is by expanding the money supply and forcing it lower with manipulation. Druckenmiller, famous hedge fund manager, says cryptocurrencies could have a renaissance if people lose trust in central banks, which is exactly what's going to happen when they start printing money during a highly inflationary period. You know, we've reached a unique time in history when Bitcoin is less volatile than bonds and fiat currencies. And here's the big picture. Limited supply of Bitcoin, unlimited amount of fiat currencies. Now, we like Ethereum a lot more than Bitcoin. For a number of reasons. I do think Ethereum could catch up to the market cap of Bitcoin in this cycle. We'll probably get another crash, and I think Ethereum will absolutely overtake Bitcoin's market cap. Okay, another chart looking at adoption rates. Are we too late to make money with Bitcoin? And you can see we're just at the very beginning. Only 4% of the world is using it. This is going to likely grow towards to 60 to 80% in the coming 2 to 3 decades. As far as signals with technical indicators, Bitcoin's 200-week moving average has only been breached 4 times, almost 5, all led to very good buying opportunities. RSI has only been this level 3 times. We had the worst month ever, the worst quarter ever. And again, this has all been driven by the bond market crash. Furthermore, Ethereum now competes with the energy sector for dividends. So not only could you see 10 times growth in Ethereum, you can make more with the staking at 5%, 4.5% to 5%, compared to the average yield of the energy sector. So just a huge opportunity here. Okay, so debt growth over 50 years, you can see they'll try to reduce debt and then chaos ensues. So unless there's a complete regime change in the way politics work and the way voters look at the issuance of debt, this is likely not going to just continue. It's going to probably accelerate. And this shows you the acceleration projected by the government itself. They always underestimate the spending. So 2021, we ran a $2.8 trillion deficit. Did we predict that? Absolutely not. Now they're projecting a nice cool run up from $1 trillion deficit to 2.3 trillion by 2032. That's really all you need to know. Only way this is made possible is driving those interest rates lower, which will drive cryptocurrencies to much higher new highs. It's just looking at the acceleration of debt, 7 trillion in 200 years, and then 7 trillion in 2 years. Okay, so that's the case to be long Ethereum. We've got about 24% of the portfolio long that. I'm getting ready to double that down very soon. But I want to see the Treasury officially commit to Operation Twist to pull the trigger. We'll likely sell our dollar position and Treasury position and load the boat on Ethereum. Okay, but we do need to be hedged against massive problems in energy, which are the worst nightmare for cryptocurrencies. And so the best way to protect your crypto position is to be long energy. And right now we're long NRGU. We made a lot of money early in the year. We're about to take a massive profit once again. And we made profits on natural gas several times this year. We're probably going to rotate out of NRGU into BOIL at the right time. We'll look at why we want to wait and be patient on that. Okay, so here's the chart on NRGU. Jumped up to 510. I think it's been even higher in the last hour. The chief commander was doing a speech. It was supposed to get oil to go down, and it's been going straight up since he started talking. Number of reasons why, but this is the big monopolistic oil companies were long. One of which Warren Buffett, I believe, owns half of now, which is Occidental. Here's oil price chart. The White House has now said they will buy oil. First it was at 80, now they moved it down to 72. They're basically putting a floor on the price of oil. So is OPEC, and so is the war. So this is going to be a really good play until the war ends, to be frank. Now we got to be careful. We're looking at valuations that are all-time highs on Exxon, and so I do think it could break to new highs. I'm ready to take some profits on this bad boy very soon. So stay tuned for that trade alert in the coming weeks. But there's that chart of Exxon making this miraculous run up over the last several weeks to new highs. So why is oil so expensive? Incredible U.S. energy policy, kill Keystone on day one, drain the SPR for elections, tell oil and gas producers to lower prices at the pump, beg Saudis and Russia to produce more, contemplate banning refined products and gas exports. So yeah, nothing has helped. Now, is it because of the war that this is happening, or is there more problems? Of course, we can see the war started and the price had more than already doubled. So that is not the only problem. We have structural problems. There's not enough investments in creating this energy. Now, this is looking at the market cap of energy relative to the total value of the S&P 500. So we've gone from 2% low, and again, leading into that, we had oil sub 35. No one wanted to invest in it. Now that oil is sky high and the profit margins are there, we can see the percentage of the S&P 500 is growing. And so this could get much higher. In the 2008 era, it got as high as 16%. So it just gives you some perspective how much growth could potentially be there. Okay, meanwhile, the war is intensifying. I see unfortunately, no peace in the near term. So we've got these drones that seem to be able to get through the air defense to the capital that are taking out energy in Ukraine. So it's getting quite ugly over there. Meanwhile, for Boyle, why is Boyle going down when China's banned it? Well, there's a number of reasons, but essentially they filled up all their reserves. They're transitioning to coal, nuclear, and oil and reducing natural gas usage. And they just can't offload it fast enough. So we've now got these ships piled up on the coast. So we need to let the pile up and the reserves start to fall. And then I will most likely get us back into Boyle. So it's been good to be patient on that play. But you can see Europe is filled to the brim. And this should last them for a few months before it starts to drain. Political pressure to end this is growing massively in Europe. So we're seeing protests everywhere. So again, this trade I see is very short term because I don't think politicians can keep this going for much longer. This is now down to 17 days from 22. Old chart didn't have an update of it. So if we do go into a real war and some of our energy is attacked, US is in a very, very ugly position. Okay, so will Russia really stop at Ukraine? Or are they going to keep going? I think they're going to look for a peace deal to recoup. I do believe that Peter Zahan, who put out this chart, is correct with Russia's long-term goals, but I do think they need to recoup and rebuild. So they're probably going to push as hard as they can to take some land, declare a victory, and then prepare for the next round of the battle. And this is where Peter Zahan believes Russia will be happy with expanding its borders. Okay, so that'll probably be our most short-term trade alerts, is to sell NRGU, rotate into Boyle, and then to look at good timing to dump our dollar position, which has been doing beautifully, and rotate that and probably the VIX into ETHE is really what I'm looking at for high risk. Okay, so let's look at some other plays. We have UVXY, the crash insurance. The stock market crash this year has been slow and orderly. So it's been a nice calm crash, nothing that the VIX would get super excited about. Last month, our UVXY position's up 22.9%. Over 3 months, it's down 2%. So it's really not doing its job to help with the downside in a slow drawdown. Usually the bond market would do the trick, but the bond market is upset due to inflation. So the only thing that's really hedged yet has been the dollar. But again, we're predicting all of this is about to reverse because the inflation has certainly been killed and is now starting to fall. Now, if we did get a crash from here, and I'm wrong, we're protected. We have over 10% in the VIX. And last time we had an epic collapse, March of 2020, the SPY went down 25% in 1 month. UVXY went up over 1,000%. So a 10% position literally doubled the value of your entire account. Now, this is an analog comparing the 2008 crash to today with the VIX. And you can see it led to a massive spike in the VIX. So we're holding on to that until we see essentially interventions to drive yields lower. And that's when we will exit that VIX and make some big changes in the portfolio. Okay, this is looking at what happens when you buy the S&P 500 when the stock market's down over 25%. And in general, now again, this is looking at different declines for the bottom, but a year to 3 to 5 years later, the returns are just astonishing. So we may not be at the very bottom, but in general, this is a beautiful time to be accumulating positions. This is looking at how many times the NASDAQ has had over 90% of the stocks below the 200-day moving average. And it's only happened a few times. And it's led to extremely bullish conditions. This is looking at the dollar index hitting these levels and some of the problems that have been created. Right now, we're essentially collapsing Asia and Europe to help kill the inflation in the US. So that's where the pain's being seen dramatically currently. A lot of times the Fed overdoes rate hikes and creates crashes. And this chart is circling all the times this has occurred. It's not showing you all the times they've manipulated the markets to save the day. And so I think they have the opportunity to pivot and save the markets right now. Okay, now we're going to look at our bond position with TMF 36 shares. Okay, this is looking at the federal funds rate in red and the 10-year yield in blue, and then GDP growth in the light blue. And the main observation I want you to see is when the federal funds rate gets above the 10-year, it's usually the end of the hiking cycle, and interest rates are soon going to collapse lower, either for good or bad reasons. So right now, we think treasuries are a very safe bet relative to stocks, despite the constant sell-off here. The risk reward is looking very, very good here. So our safe growth strategy will most likely be heavier in the treasury market when we make some major adjustments compared to the high risk, which will go balls to the wall with Ethereum, FNGU, NRGU, and BOIL, which are the riskier assets that can deliver greater gains. Here's your TLT going far lower than I thought possible. And again, interventions will be necessary very, very soon. TLT can crash, but once it does stop, it typically ramps up higher and has beautiful returns. And that's because that's the only way governments can expand debt, is to drive interest rates lower. So once again, we either need to believe the government's going to reduce spending and actually spend less than it makes, or they're going to manipulate these rates lower because otherwise they can't continue to operate as they are. Okay, so the investment grade bond market is crashing to levels that we saw in the March 2020 lockdown. The junk bonds are doing less pain, which is interesting. We're not in either of those plays. Now we're looking at various interest rates across the spectrum for the US government. This is a 3-month. Again, the trend were lower highs for the last several decades. So this is highly unusual to be nearly double the recent high. Now what comes next? It flattens out and then it crashes back to zero. And that's really the trend. In fact, I believe to keep this system in place globally, they will have to push these negative over time. 2-year often dictates where the federal funds rate will end up. And so this is saying we're going to go to 4.5. The 10-year does not believe this is possible, and why it's trading below the 2-year. So the whole yield curve is now inverted. This typically, again, predicts much lower yields in the very near future. It can either come with a stock crash or a rebound, depending on when the pivot occurs. So there's that 4.5% on the 2-year, which is dramatically higher than the federal funds rate currently. Here's your 10-year trend. Again, heading back to zero is the path to continue the debt. 30-year, same thing. Everything is way out of trend, and this is extremely problematic. This must be corrected. If it corrects on its own, it will likely be a stock crash. If the government and central banks correct it, it'll be likely a stock boom. Okay, the Italian 30-year, same trend, way up. So ECB will likely have to go into QE. They've done very little quantitative tightening compared to the Fed, and obviously why. Okay, so the inputs are all crashing. So the inflation has been contained, in my opinion. It's just lagging and is going to fall. over the next year. So here's lumber futures, which went from 1,300 down to 500, down 58% year to date. Copper, which was at around 480, now at 333, down 24% year to date. The cost of shipping commodities between continents has crashed 18% year to date. Wheat futures are actually rallying, up 3% heading into election. So we're still seeing sticky food inflation, but overall, the food index has been falling. Consumer sentiment is at Michigan consumer sentiment reading is below the lockdown reading and at below 2008 levels. So people are very, very pessimistic about this inflation and loss of purchasing power. Okay, initial claims starting to pick up. If this hits 300,000, that'd be very, very bullish for a Fed pivot, but we're still seeing a very strong labor growth. So it's important that this Bank of America prediction plays out here. The 2 minus the 10 is inverted, and now what a lot of people are saying, well, it's really the 3-month against the 10, and that has slightly inverted. Typically marks peak interest rates and problems ahead. Okay, so this is just a look at the Board of Governors and which Fed speakers you should pay most attention to. For example, Neil Kashkari was on TV yesterday, non-voting. So we'll pay more attention and highlight what speeches which board members are speaking about as we get closer and closer to the November, December policy meetings. So far, they're all being very hawkish, saying we're never going to stop hiking rates. Let's look at the total wipeout in bonds globally. And it's just one of the worst crashes in bond markets in history. Now, this is showing you how fast we've hiked rates, even though it's not to such a high level. The rate of change is the fastest in history. And without question, this slows the economy. Okay, so this is a breakdown of the CPI, just so we can look at it. So we're worried mostly right now about shelter and food. Okay, we know energy is down dramatically from recent highs. So we went from 134 down to 80. We're back to 92. That one is 7.5% and could be problematic if the war dramatically escalates. So we'll keep a close eye on that. Food is falling for sure. Medical costs are crashing and shelter is absolutely falling. So the big components are in our favor. A little patience and this is going to play out. Octavio Tavi Costa says if the Fed raises 75 basis points next month, it would intentionally invert the spread between the 10-year and the federal funds rate. So that's what we're looking at here. And this typically marks the end of the hiking cycle when those two invert. This is looking at when yield spreads on the 10 and 2 have inverted in history. And what happens next? Interest rates crash. Again, it can be for good or bad reasons. And why treasuries are so popular in general, because they can make money in a stock market crash or a rebound. This is looking at the CPI broken down with color coding. I want you to note energy led the inflation. And now we're having food, goods, and services follow, but negative. But now we've had energy flip negative. And so I do believe the other sectors are just lagging that trend. One of the best leading indicators of the inflation in the CPI was the used car index. And we got people racing to sell their cars as fast as possible. And the price is the biggest drop in history, 10% decline year to date. Paul Krugman says a quick update on the shelter and inflation. Goldman Sachs has a new research note on new rental rates. As opposed to the BLS, which is what measures the CPI rent measure, it is dominated by leases signed some time ago. They saw that new rentals are now rising 3% annual compared to the government's measure of 6%, so about half of that. If we look at the average, it's about 3%. Yardini Research has it even lower. If true, shelter inflation as a measure of overheating, not cost of living, is only 3%. That matters a lot. Median inflation tends to be very close to shelter inflation. So that measure is also now 3%. Conventional core, excluding food and energy, rose at a 6% rate over the last 3 months, driven by shelter at 8%. But if shelter, which is 40% of core, is really 3%, that means the true core is 4 to 3%. We're still running well above the Fed's 2% target, but not nearly as much as standard measures say. And if, as many believe, there's still a lot of deflation in the pipeline, he's predicting these interest rates are going to fall. Here's a look at the national asking rent decline in September. So we can see it's falling. Home buyer demand is collapsing at these extreme interest rates. Now it's 7.2 on the 30-year. Here's just a little comic. We'd really like to see something a little less expensive in front of this house. She says, okay, I can show you this house again tomorrow. So looking at CPI relative to wages and salary, we're seeing wages start to fall off. So all indications are really leading towards CPI topping out and falling. Another chart is the household net worth. So if you had a $100,000 retirement account and all of a sudden you check it, now it's worth $60,000, are you going to be as willing to buy stuff? Of course not. And so this is predicting again that the demand is going to shrink due to household net worth being negatively shrunk. Okay, the argument for the dollar, 14 shares. This is something we want to rotate into Ethereum as soon as we get Janet Yellen, the ECB, or the Fed. Really, once we get America pivoting, not Europe. If Europe pivots first, EUO is actually a great play. But I think we're going to see the US have to move quickly as well, probably with Janet Yellen. Here's the DXY since the 80s, actually since the 70s. I want you to note the highest price on the dollar in each crisis relative to basically the euro and the yen is shrinking over time. So we're getting lower highs over time. And so that's really what we're looking at. Not only could the dollar index fall to 90, it could fall to 80 or 70. And that's when you get your Bitcoin exploding way above 200,000. Now, EUO this year is up 35% year to date. The euro against the dollar is down 16%. The yen is down 30%. They're already printing money, protecting their bond market. They were the first to do that and have been doing it for decades. The Chinese currency is falling apart against the dollar, down 13%. Only currency outperforming is the Russian ruble because of their high energy exports. Live Monitor says DXY to 120 incoming. Europe has no choice but to do yield curve control soon. EU pensions are on the verge of blowing up. They may not even make it to the next ECB meeting. But now the US is in the same problem with interest rates going to these levels. China signals massive dollar dump after yuan losses. People's Bank of China told major state-run banks to prepare to shed dollars. So how do they get those dollars? They sell treasuries and stocks, and plus, of course, the money they collect from imports. And it's just a global problem. There's only two currencies outperforming the dollar, the Brazilian real and the ruble, both high exports of energy. Some more charts, just more currencies getting demolished by the dollar. This trend must reverse soon. It's only being done to get the US inflation down to protect our bond market long term. Okay, stocks, buy 27 shares of FNGU, 3 times tech giant. I pulled Buffett's portfolio. So he's long tech with Apple. For us, that's Ethereum and FNGU, which has a huge Apple play. And then he's hedging with inflationary protective assets, which would include banks and energy companies. So, and people who produce the food. So you can see some of his big plays are Occidental Petroleum, American Express, Chevron, and Bank of America and Coca-Cola. So our strategy is very similar to Buffett's currently. And the ratios are even pretty similar. Okay, so FNGU topped out around 44, just like ETHE, trading at 550. This is going to be an incredible play. And I've decided to keep it in the high risk because it's going to make so much money. The Safe Growth already has huge exposure to a wide variety of equities. In that portfolio, I'm more interested in loading up on treasuries to make it safer as soon as we get a really nice bounce on our equity positions in that portfolio. Okay, FNGU over the last 3 months, just ugly, ugly, ugly. Again, these are big tech companies, leverage times 3, that get massive call options. Now we look at indexes. SPY's down 20%, the NASDAQ's down 28. This is from January. Of course, December is when the crash began. Emerging markets are performing like the NASDAQ, down 29%. This chart shows us that every other cycle, emerging markets outperforms. It's primarily due to interest rates falling and the dollar falling. So the next setup for emerging markets is beautiful with ticker EDC, which we're playing with the Safe Growth portfolio. Now, I'm worried about Europe collapsing, something like what happened leading into World War II. So after World War I, everybody wanted reparations from Germany. They collapsed Germany, and the contagion spread and led to the Great Depression in the US. And that was after the Roaring 20s. So are we on the verge of repeating history by making this war get worse and worse and collapsing Germany's economy, which is certainly happening right now? EFA, the European index, is in lockstep with emerging markets and the NASDAQ. So not believing the contagion's there yet. We're long uranium in Safe Growth, down 18%. We're long rare earth metals like lithium for batteries for electric cars and phones, down 22% year to date. Some of the specific leaders in FNG are Amazon, down 29%, Apple down 16%, Alibaba down 43%, and they lost another 40 last year. So this is probably one of the cheapest companies in the world with their long-term outlook. Meanwhile, the stock buybacks are going to hit record highs, and no one's taking risk. There's trillions of dollars on the sideline. So as soon as this pivot occurs, the short squeeze is going to be beautiful. Returns per decade are just really, really impressive with the S&P 500. When you break it down evenly per decade, only a few negative in the 30s and the 2000s. Usually don't get big crashes when everybody's hedged. Everybody's hedged. Everybody is hedged right now. So I do think we're really got a beautiful setup for a big rally, probably into April. Now, midterm years tend to bottom later in the year and see large corrections. Of course, the policy mistakes this time are just outrageous, but 1 year later, assuming we're at the bottom and this trend continues, average return in a year is 33%. And we're using leverage products times 3, so that could be 100% or more. Just one example of the massacre. This is, again, probably due to banning exports to China for chips, but Intel now down 62%. During the 2008 crash, it was only down 55. Okay, is the US consumer dead? Well, consumer spending just hit a new high. Balance of trade is shrinking, but still we're importing lots of goods. This shows our strong dollar is letting us get more goods for less money, reducing the inflation. Retail sales continue to grow. Consumer credit continues to grow. Bank credit continues to grow. PMIs in China are still positive, the manufacturing hub of the world. Now, is China going to cut off manufacturing to the US since we've killed their tech sector? That's a problem we need to worry about. China's exports and imports still healthy, so we're not seeing the whole economy crash. We're just looking at a slowdown. All right, great. So that's our presentation today. If you're not a paid member, you're not going to see the next set of slides, which are critical. So call Dean to upgrade at 505-322-7515. Okay, I'm going to switch to